Well, hi folks, another Tuesday evening. Let's put the pre-show on for a moment. Hope everybody is well. Whether you're calling in from various parts of Australia or New Zealand or indeed Florida in the US or wherever you are, hope you're all well. It's just me tonight, of course. I'm going to be talking about some of my data, but the doggies are here. And they now look a lot neater than they were. Meteor was all sprawled out, but looking a little bit neater now. And of course, the studio is set up. It's pretty much figure the same, except we don't have the guests because there's no guests. It's just me. And we're going to look at some of the data tonight that we've been looking at more recently. There's a lot to talk about, I think, particularly with what the RBA did today or didn't do, and a few other things too. So that should be quite fun. And we had a load of postcodes bolded us, some of which we're going to cover tonight, some of which we may have to do in a separate show because there are just so many people now asking questions about property trends and stress trends across postcodes. So it's quite an opportune time to have a conversation. Anyway, we have now hit the watershed, 8 p.m. So I'm going to take the pre-show off there and I'm going to start the show. I'll be back in just a moment. Well, good evening. Welcome to this live stream on the 16th of June, 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking time out of your Tuesday to spend it with us. Really appreciate it. And whether you're calling in from Australia or New Zealand or even in the US, Florida, I think somebody said they were in. So we're all over the place, which is good. So welcome, welcome. And we're going to have an interesting conversation this evening about property-related issues. The RBA, of course. We had a load of postcodes bolded us before the show as well, so we'll cover some of those. And we'll take some postcodes live as well. So it's, I think, a good place to get into this. Before I do that, remind you that we're not providing specific financial or legal advice. We moderate the chat, but do feel free to throw questions and comments in. If you use that DFA, that'll get into my queue. And I've enabled Super Chat, which means you can get your question to the top of the list or indeed make a contribution to what we do around here. We appreciate all those who support us via Super Chat, Patreon and PayPal. Makes a big difference to us being able to do this. We don't do this for profit. We do this because there's an important conversation to be had. And I think at the moment, this conversation is pretty important. And yes, Cookie, we are going to use some of those slides that you've been bowling us as well. Thank you very much for that. You certainly helped to make the show what it is. So Cookie, thank you very much. And Jason, nice to see you dropping in there. And lots to talk about, of course, tonight, particularly property related. Now, I called this show Property Pressure Building, a postcode deep dive, because there is a lot to talk about here, particularly, I think, bearing in mind that there are lots of different and quite varying conversations going on, some of which I think are misleading, some of which I think are a little bit less misleading. So let's look at some of that tonight. And as I say, we had a lot of people wanting postcode information. It's very interesting. When things are going well, the number of people asking for postcode data in these shows drops dramatically. When things are going less well, we get a big spike. And I can tell you that I've had more than 70 requests. Now, don't worry, we're not going to do all 70 tonight. If we did, that would be a 5-hour show or something, but I will work them into future shows. And just really starting out, let's talk about the RBA, because, of course, the RBA today held the cash rate at 4.35%. That was expected. But it was interesting if you look at what they actually said. They said that the underlying and headline inflation is still too high. There are signs that firms are looking to pass the costs on because of the pressure on their prices. And whilst expectations have eased a little, they're still higher than earlier in the year, which we'll come on to in a second. There are signs that housing prices are falling in some capital cities, so things are shifting. Growth in consumer spending is slowing. The unemployment rate is higher than expected, although it's still below the 4.7% that the RBA was thinking it would be later in the year. And there are heightened uncertainties still about the outlook. Questions about what's happening in the Middle East. Prolonged uncertainty might cause growth to be lower. And they go on to talk about inflation is likely to remain high for some time. They're worried about inflation being embedded because that pass-through from higher oil prices could filter through more widely. Inflation is still too high, and they judge that it's appropriate to leave the cash rate unchanged while it assesses the response to the previous rate rises. Remember, we had 3 over the last 3 meetings, and also the impact of the oil supply disruption. And they go on to say that it will do whatever they need, including lifting the cash rate further if required. And the decision today was unanimous. So that's the sort of starting point. And I do think it's very interesting that if you listen to the press conference as I did, Michelle Bullock was very clear about the fact that inflation is still a big problem. Unemployment is a little higher, but it wobbles around a bit, so she's not too concerned about that. And in fact, they were forecasting 4.7% inflation. So they did, I think, leave the door open to significantly higher probability of another rate rise later in the year, which is quite reflective of what Warren Hogan said actually before the rate rise. Everyone thinks the RBA has done their wrong, and in fact, his article was quite fascinating. And it wasn't published in the paper version, but it is available online. The inability to control and contain inflation over the past years is a very significant factor. It can't be underestimated, the role of the persistent above target inflation on the economic and political terrain. And Australia cannot afford more economic policy missteps for the RBA to pause its tightening cycle with a real interest rate barely above 0, which we were talking about back in 2024. Won't work in 2026, therefore expect higher rates. And I think that's an important point. I think that it is quite likely that we are going to see more upside pressure. And it is, I think, just worth reflecting on that. The 2-year Australian bond rate at the moment is at 4.463%, which is down from where it was a few days and weeks ago. And of course, the forward interbank rate, this is the 30-day interbank cash futures rate, has come back dramatically. It was above 4.6% at some stage. But I do think this is important. This is the inflation expectations. It's still high, around 6%. And of course, we have very limited per capita growth. Under Albanese, it's pretty much nowhere compared with some of the previous governments. And Michelle Desai did say today that with growth being so slow and particularly the productivity being so limited, it was hard for the economy to grow without busting capacity constraints and then imposing more inflation. So the inflation battle is absolutely still there. So let's turn specifically to property. But before I do that, it is worth just standing back and thinking a bit more broadly about another decision, a rate decision that was taken very recently. And that, of course, was the Japanese rate. So Japan put the rate up, and it's worth just taking account of what that looks like, because let's just go to that one. Hang on. Sorry, I just need to push a button here. Got too many things going on. Okay, there you go. Okay, so this is the Japanese 10-year bond rate, and you can see that it's now at 2.654. But it is significant to my mind that, in fact, Japan has now lifted their rate again. And he's talking about the battle with inflation. And when you remember that Japan had a very, very low interest rate policy for a long period of time, cheap money is disappearing. And that is a trend that we're seeing in other countries too. It'll be interesting to see what Walsh says later on his first outing as the Fed chair. Probably won't lift rates, but of course, inflation in the US is higher. And there's an expectation in other places the ECB lifted rates too. So we are in a trend where rates are bubbling higher rather than not. And I think it's probably going to be the case that the RBA will need to do some more lifting later, which then flows directly back into the questions about what will happen with regard to the property sector. And that takes us to property pressure building. This is the show I published the other day, where I highlighted some of the high-level findings from our surveys. We're going to build on that today. But on the way in, it's worth highlighting that the total value of dwelling stock in Australia, according to the ABS, is 12.7 trillion. It's gone up again. And you can see that in their sense of measurement, other than in Victoria, the mean price of dwellings by state continue to rise in pretty much all states other than Victoria. And the mean dwelling price is rising, well, in most places other than Victoria. Now, that's historic, of course, and in fact, the latest data from the PropTrack series, which was published in the Australian, showed that the monthly growth was down in Sydney and Melbourne, across capital cities on average, and nationally down slightly. But the median price is still very extended, and the 5-year growth is still very strong. Perth more than 100%. So we still have significantly bubbly things going on in the property sector at the moment. Another way of looking at it, this is the AMP chart, which shows how prices have trended. But I actually think this is the real interesting slide. This is from Cotality, Westpac, Melbourne Institute and AMP. And it shows you that the house price expectations are dropping, that the time to buy a dwelling index is dropping significantly, and prices are falling. So the question is, how big are the current falls and how significant are they and what does it mean? Because there's been a lot of significant commentary in the papers about this, of course, and here's a good example. This one here, house price in free fall, $150,000 white from the Valley of Coastal inner middle ring homes as downturn hit hard. And this is using very recent data from PropTrack. So, for example, Parramatta houses down 10.3%, Crow's Nest houses down 12%, Mossman units down 15%, and Killara units down 16.8%, and Dundas units down 20.8%. Now, those are some specific examples. And it is, I think, worth highlighting that, of course, not all properties are going in the same direction, even in those areas, but that's quite interesting. And here's another angle. Housing cool down hits the most populous states. So this article is again suggesting that we are seeing it. Here's another one. Heat map shows brutal reality check for Melbourne property vendors as they slash prices by almost 30%. Well, 30% is a lot if that's true. And spooked Sydney real estate hits 8-year slump. That, of course, is about the clearance rates. I made a show on that, as you can check out. But you can see there that the true clearance was about 40.1%, which is quite low. Volumes are low, clearances are low, and it's, as this slide here says, a former Treasury economist has claimed falling auction clearance rates are making conditions worse for first-time buyers, the same group the government want to try to support. Or as Koshy put it, most people can't just pluck money out of thin air. It's going to mean making some serious lifestyle changes with things like holidays and family outings potentially on the chopping block. That's because of the higher interest rates, and demoralised first-time home buyers lose hope as the goalposts keep changing, according to news.com. In the rental sector, significant rises in rents pretty much across the country, but Darwin leading the way with Hobart and Brisbane. And also the vacancy rates are very low. Nationally, the vacancy rate's 1.2%, but you can see there that in some areas like Darwin and Hobart, they're a lot lower. And there's a consequence also more broadly. So there's a drop. Westpac reported a 20% fall in their investment loans over the last 3 weeks. And Equifax showed that, in fact, overall mortgage demand has dropped. It dropped 0.9% in April and dropped 6.6% in May. And first home buyers are seeing a steeper drop off, refinancing is also fading. So what was last month a slight handbrake on mortgage demand, this month after the successive rate hikes looks to be significantly more dramatic. So there's, oops, I keep putting the wrong button, sorry. So there's no guest tonight, so I've got to remember to push that button rather than that button. So there you go. That's the story with regard to the backcloth here, which takes us quite nicely then to, well, so what are my surveys saying? And here's the, let's go here, there we go. Here's the latest from our surveys. To remind you, 52,000 households, 140 fields. It's quite comprehensive. We do it every month, update it. And we're using this information to drive our modeling, slice and dice it lots of different ways. You've seen these slides many times, I'm sure. And also we can think about what may happen ahead, looking at scenarios. And those scenarios then power everything we do, from stress, price, buying, selling intentions, migration, the CPI, all of it. And that means we can look at it from a postcode level, region, state, or Australia level, and form a view of what may happen. Quick plug, if you are interested in the one-to-one conversation, we're still doing it. That's a chance to have a conversation with me. It's not specific financial advice, but it is discussing my data. We can look at the stress data, the home price and trends data, a bunch of other things too, and all look at our modeling. And if you want to arrange for a one-to-one conversation, about an hour by Zoom or phone, you can do that. There is a cost involved, simply because a lot of research is required to put it together, and we're booking 3 to 5 weeks ahead. Check out the blog if you'd like more information. Now, let's get into the stress specifically, because this is an important conversation, particularly now. And to remind you that when we talk about stress, we talk about cash flow, money in, money out. There are also other ways of defining stress, from 30% of income through to underwriting metrics, but I look at it money in, money out. And that means that if you've got more outgoings, I knock off one-off discretionary items like holidays, for example. We define people as stressed. If they've got a mortgage, they're in mortgage stress. If renting, they're in rental stress. And also investors, if they have cash flow pressures, they can be stressed as well. And we can aggregate it up to the financial stress level for the postcode. And we can look at it both in count and percentage terms. Count is probably the more significant factor because it's the law of big numbers. Now, this next chart, I always show this because I do think the RBA did a really good job in showing this particular way of thinking about the spectrum of financial stress. And they said in the early phases of financial stress, you have budget pressures. I measure stress in this early mild phase of budget pressures, but it can morph into missing payments later, or worst case, insolvency. And this journey from mild to severe can take anything from 3 to 5 years. I measure it in this early phase. Not everybody gets through into missing payments and insolvency. The banks, of course, help to refinance, going interest only, and other levers that they can also make as well to try and actually keep people from being reported insolvent, because, of course, insolvency means they have to put more capital against those loans. So the banks don't want that. One of the reasons why the overall insolvency rates are still very low at the moment. But budget pressures are where I'm at. And the reason that's important is because when you look at what's going on at the moment, and this is actually the latest stress trends, you can see that to the end of May, rental stress is up again to 74.4. It came back slightly thanks to the low paid wage rises that came through. But unfortunately, rental costs are continuing to rise and inflation is still very strong. If you go to the mortgage stress, that's up now to 53.3%, and that's with the rate rises that we've seen. And the RBA is saying that debt to income ratios are 177, but that includes all households, whether they have a mortgage or not. So that's a bit misleading. I think it's closer to 6 times for many people and 7, 8, 9 times for many others. So here is the May data. And the May data is just a quick recap of what I said in the earlier show. So we can see that we've got 53% of people in mortgage stress. That's more than 2.1 million. We've got 74% in rental stress. That's more than 2.3 million. And we've got 17.8% of investors in investor stress. That's 500,000. And overall, 50.1%, or more than 5 million households, have cash flow pressures. And just to be clear, this is in yellow where it's gone up from last month. And you can see there that, in fact, 50.1 is up again, about 10 million households, so about half. Also worth noting that by cohort, there's some quite interesting things going on. I've always believed that this is an important way of thinking about it, because in the disadvantaged fringe, this is in the urban centre around our major cities, there's a large number of people in mortgage stress. And interestingly, that is an area where one nation is now making significant inroads in terms of preference. I think there's a correlation. I'd also highlight that rental stress, from a count perspective, is now sitting in the suburban mainstream, 384,000 households there. But if you look at it in percentage terms, it's a bit of a different story, because there we've still got a lot of those first generation Australians, 81.9%, new migrants, who've got pressure, rental stress pressure. But wealthy seniors are now have a big issue too. And this is what I'm expecting to see more of, because we've got a lot of people going into retirement who have their own incomes, but are still having to pay rents because they don't own their own property. And those rents are going up dramatically. So that's another factor. If you look at the investor stress, exclusive professionals, because they've got the largest share of investment properties, have some pressures. Some of them are selling those investment properties now, by the way. And overall, if you look at young growing families, well, 94% have mortgage stress and 72% have financial stress. And that is the most stressed cohort. So young growing families, new first-time buyers, those very people, of course, who were cajoled by the government to go in with a 5% or 2% deposit and are now potentially looking at negative equity as well. Now, here's a quick take of the top postcodes before I get into the detail. And you can see there that Liverpool, 2170, and Roxburgh Park in Victoria, and Wanneroo in Western Australia at the top of the list, Campbelltown, and Toowoomba, Narre Warren, Camden in New South Wales, Tarneit in Victoria, Pakenham in Victoria, Cranbourne in Victoria, Ballarat in Victoria, regional area there, Berwick and Harkaway, Victoria, and Durham and Riverston. Now, a lot of these are high growth corridors, a lot of new properties, a lot of newly mortgaged households, a lot of first time buyers. And you can see there that the proportion who are actually stressed is quite high in some of these areas. We can do the same for rental stress, and we'll do that here. And in rental stress, you can see that the centre of Melbourne is at the top of the list, then Toowoomba, then Liverpool, then Westmead, Tarneit in Victoria, Southport in Queensland, Campbelltown in New South Wales. And so it goes on. Come back to mortgages, I will highlight the risk of default. It's in these high growth corridors, Cranbourne, Tarneit in Victoria, top of the list. These are the people most likely to default over the next year or so. A lot of people here with quite new mortgages and default rates of 4 to 5% in some areas. Queensland is also up there with Bundaberg and Toowoomba as well. And Gosford, of course, as well there. So on the coast. So these are all very important factors when you think about what's going on in the marketplace. And some of this is now translating to people's behaviors with regard to what they're trying to do. Up until recently, people were dialing back, putting more on loans, putting more on credit cards and muddling through. But we're seeing the end of that now. So more radical steps are having to be taken by some households to deal with this pressure, because this pressure is building, and it's building whether you're in the rental sector or you're in the mortgage sector. And just in terms of financial stress, this is the overall summary here. Liverpool in New South Wales, top of the list with 72% of households caught, then Toowoomba in Queensland, then Campbelltown, New South Wales, and then Tarneit, Cranbourne, Roxburgh Park in Victoria, Dermont. Westmead in New South Wales, centre of Melbourne, Wanneroo, Ipswich, Blacktown, Mount Druitt, Ballarat and Pakenham. So that's where the most stressed counts lay. And I think that's quite important to understand at the moment, because there is a lot going on here when it comes to the consequences. And I want to highlight again, some of these postcodes are the very areas where the One Nation preference looks to be rising, whilst the households there are walking away from the uni parties, particularly, of course, Labour at the moment. I think that's very significant. Now, let me move on to talk about some of the other things. Now, of course, I look at this data in lots of different ways: stress, rental stress, financial stress, the defaults. I can look at gross investment returns, net investment returns, the net wealth footprint, and gross debt footprint. So I'm not going to do that all today. I might do it in a later show. But the other thing I do is scenarios. And scenarios are a way of understanding what's going on, not to try and make a prediction, but to show you how the sensitivities work. None of the scenarios may be turned out to be true. Things will change ahead. So it is quite interesting and important to look at this. And here are my three scenarios at the moment. So the best case, the Goldilocks zone, we see rates staying at 4.35% until the end of the year, and then ease as we go into 2028. Inflation stays above target until later in 2027, though, and migration remains above average. We still see momentum amongst first-time buyers. We don't get a recession. We see a slowdown in wages, but the government is going to throw more cash out there, particularly for first-time buyers, to keep them effectively buying into the market. So that's probably the best case. And it's interesting that, of course, the RBA is saying that inflation won't be back in band for another couple of years, which would be more than 7 years from when it was last in band. So the RBA has done a very bad job, as Warren Hogan keeps highlighting. Soft landing, base case, we see another rate rise later in the year, maybe September, October time, to 4.6%. Then it's held there. We see inflation easing in line with the RBA expectations into 2028. We see wages rising slower than inflation. Unemployment rises slightly above the 4.7% the RBA was expecting. We get a recession in Australia, and we see slowing migration. And the nightmare scenario, the worst case, is we see more rate rises, 4.85%. Inflation steps up. Unemployment rises. Wages growth stalls. We get a rate cuts later, but it's too late, just like it was a couple of years ago. Migration drops to average. We get stagflation. So those are the three that I use, not because they are the only scenarios, but because they show you some sensitivity bands and ranges. And if we then look at that, here's the average for Australia. You can see there that in the best case scenario, on average, there is still price growth across Australia. Those vary by locations. We'll see a bit later. On the second scenario, the base case, there's a bit of a fall, maybe 10% over 3 years on average. And the worst case, if things go really pear-shaped, there's still a risk down to 30%. It's because, of course, we are sitting in a bubble, a property bubble and a debt bubble, and those things will shake out. Units following on with a slightly smaller fall ahead. So that's a starting point for our conversations. Now what we can do is to move forward and look at the individual areas, the postcodes, because I incorporate all this information, the stress data and also the scenario data, into the postcodes. And that then gives us a very significant starting point for understanding what is going on. And at that point, what I can do is go back up to the start of the show, because we had a request come in before we started from Moombo. And Moombo wanted to see 2251. Well, we can do that. And thank you very much for the super chat. We really appreciate it. So if I then switch to the chart and bring it up. So this is 2251. And 2251 is on the Central Coast, places like McMaster's Beach and Greenpoint and Daveston, places like that. And it's a very significant and important area because there are a lot of people who moved out of Sydney and went up to the Central Coast, and they're now beginning to find that it's not quite gone according to plan. So let's quickly look at this. 13,000 households in this postcode, of which 37% are outright, but 44% are borrowing, and 19% are actually renting. Looking at the stress, 47% have cash flow pressures, with the mortgage, but a lot of renters may not be quite 100%, plus or minus a few percent, but a lot of renters have rental stress and overall financial stress is at 42%. That level of stress tends to have a depressive effect on my scenario modeling. We can see that it's mostly houses in the area. We can see that the people ratio is quite high. So this is quite a lot of families, not just individuals. And we can also see that there's some vacancies there. Now, this, of course, goes back to the last census, and the vacancy rate included Airbnbs and that sort of thing, and of course the fallout from COVID. So this is a bit artificial now, but unfortunately we don't have more recent vacancy data that we can throw at this. Gross investment yields, that's the measure of the ratio between average prices and average rentals, 3.4%, but net investment yield, which is the real cash flow outcome for an investor, is negative 1.1% down. And looking at the taxable income, 98,000 from the ATO in the tax year 22-23, 89,000 per household from the census, which gives a disposal monthly income around 5,600 on average. And this means that the average proportion of disposal monthly income going on the mortgage is around 46%, more than $2,600, and 40%, $2,243 going on the typical rent. That's where the pressure is. That's why there's so much stress there. And looking at the scenarios, it's hard to see how we're going to see price growth in this area over the next 2 or 3 years. Even in the best case scenario, I think there's probably going to be further small falls, the base case more significant falls, and the worst case a very significant fall. So there you go. That's the first one that we've looked at. And I want to say again, thank you for the super chat. Really appreciate it. Now, we also had, before the show started, a request for 4120. So I'm going to do that one, which is this one here. And this is up in Queensland, Green Slopes and Stones Corner. And they're just over around 5,000 households with 54% renting and 31% borrowing and only 13% owning outright. Mortgage stress at 34%, rental stress at 88%, giving a financial stress measure of 62%. So that was higher than the previous one. You can see there that 40% of houses, 50% of units. You can see there also that the people ratio is a little lower. Vacancy rate at 8%, which is quite high. So possibly that could be some new properties or Airbnb there as well. Gross investment yield is 4.1%, but the net investment yield is flat. And I'm seeing this now across a lot more Queensland postcodes, where net investors are not seeing any return. They're hoping for capital gains, of course, but on a cash flow basis, zilch. And the taxable income, 94,000 from the ATO, 101,000 from the census. This is a household level. Disposable monthly income around 7,400 with 30.4% or $2,280 going on the typical mortgage and 25.3% or 1,894 going on the typical rent. And looking at the scenarios, in the best case scenario, yeah, sure, there is a small amount of upside and then going sideways in the best case scenario in this particular area. But in the base case, a fall, and in the worst case, a more significant fall. So that's my take on that particular postcode. And it's quite interesting. I'm starting to see a little bit of a change in the way that the story goes in Queensland. Of course, Queensland has been booming for quite some time. And it looks to me as though we are seeing some early signs now of the property market beginning to morph slightly differently ahead. Now, okay, we've still got the Olympics and that could provide some support, etc., etc. But it is quite interesting just watching how all of this plays out. So what I'm going to do now is to have a look at some of the other ones that I was asked to do beforehand, and then I'll come back to the chat and I'll make time for some of the ones that you'd like me to see now. But let's start with this particular one, and I'm going to put this slide up. This came in from Matty, and Matty asked about Point Cook 30 And I will just show you, because when I get this request beforehand, I can do a bit more work. This is actually the movements percentage change over the last decade for prices in Point Cook. And you can see that actually, other than in 2019 and 2023, prices have risen. And that gives us a little bit of a guide from 634,000 in May 2017 to 893,000 in May 2026. But that's not the full story. If you then take a slice over the last year or so, from June 25 to May 26, here's a quite interesting scenario. We saw rises through until January. And then we've started to see falls. And in June 25, we were 863,000 on average. And now we're 893,000. So you can see that there's a bit of a change in the weather. I think it's quite fascinating, quite interesting. And again, I am seeing this in a number of different areas where we're starting to see prices beginning to morph lower. Now, not uniformly so, as we'll see as we go on, but there is something happening in a number of areas to prices. Asking prices are being reduced, and in some cases, even if asking prices aren't being reduced, if you want to sell, you have to accept a lower price. And I do think that we're going to see this happening significantly around Melbourne, particularly in the outer suburbs of Melbourne. But I'm seeing it now in other places like in and around some areas of Sydney. And interestingly, just starting to see some of those trends up in Brisbane too. In the West, different stories, we'll see. And in fact, the next request came in from Be Right Agent. Thank you very much for that. Atterdale in Western Australia, 6156. And I want to show you this one because this is quite fascinating when it comes to what is going on. So let's start with the price data. And this is the movements over in Atterdale, 6156. And you can see there that there was considerable rise from May 2017, 1.038 million, to now 2.36 million in May 2026. But we also need to look at the stress data here, 6156. So let me just put that in and cut across to the other chart. Okay, so this is 6156, and you can see here that there we've got 7,300 households. We've got a third, or 31%, owning outright, 45.9% of borrowing, and 22% of renting. Mortgage stress at 45%, rental stress at 81.5%, and overall financial stress at 50.1%. And we've got mostly houses at 77%. We've got a high people ratio, so a lot of families in these areas. The vacancy rate is 7.5%. Gross investment yield is 4.3%, but net investment yield is minus 0.4%. And looking at the taxable income, 129,000 from the individual ATO data, 111,000 from the census. That gives a disposal monthly around $6,700. 39% going on the mortgage, $2,639, and 27.2%, 1,843 going on the typical rent. And looking at the price scenarios, well, I'm struggling to see significant momentum ahead. Now, I could be wrong, but even in the best case scenario, I'm expecting prices to sort of ease and go sideways in these areas because of this high stress level, especially if we see further pressure on rents and rates. And if we see also interest rates going up again, then we'd see a base case of, well, a bit of a fall. Remember that property prices in this area have dramatically shifted. And it is, I think, worth highlighting the fact that the story here is definitely one of some significant pressure because of affordability but potentially some pressure also because of all the issues ahead with regard to supply and demand and all of those things. So it's a complex situation. Interesting to see how that plays out. Now, I want to go back now to Point Cook and just put 3030 in so we can look at the detail here, because I didn't do that before. The reason I did it like this, because I wanted to show you that there's some similarities with some of these areas, but the trends are a bit different as well. So 41,000 here in 3030, 51% of borrowing, more than half of borrowing. So it's high growth, a lot of new borrowers here, a lot of first-time buyers. A third are renting, 44% in mortgage stress, 69% in rental stress. Overall financial stress at 48%. Mostly houses, 86%. And you can see there again, the people ratio is high. So we've got a lot of people in families here. The vacancy rate, 7.4%. Gross investment yield is around 3, but the net investment yield is significantly lower, minus 1.1%. Average taxable, 89,000, compared with the census, 106,000. But the multi-flag has come up. That is because multiple incomes, 2 incomes, are going to pay the mortgage. That gives a disposable monthly of around 7,500, with 31.8 going on the mortgage and 24.4 going on the rent at 2,400 versus 1,849. And because of the parameters here with regard to the stress data and the fact that we've got the multi-flag up and a few other things, I'm still thinking even in the best case scenario, we're going to see more falls in this area. And if indeed we see the base case scenario playing out, then the falls will be quite significant. So it is interesting to compare and to contrast different postcodes. And you can see quite clearly that you get quite different outcomes based on what is actually going on in individual areas. Okay, so let's now look at another one that came through beforehand. And this is Upper Kedron 4055. And Simone says, thanks, Martin. Great reporting. Could you please do postcode 4055? Of course I can. I'll start with the price information. So this is the trend over the last decade for Upper Kedron. And you can see there that, well, there were small falls in 2019 and 23, but other than that, it's up and away, more than 15% in some years. And that's taken the price from 617,000 to 1.43 million a year, a decade later. And if we look at 4055 in my modeling, what you can see here, there's about 8,000 households. We've got 55% borrowing. So again, this is another of those highly mortgaged areas, 26% owning outright and 80% are renting. We've got 47% in mortgage stress and 75% in rental stress. We have overall financial stress at 48%, mostly houses in this area. People ratio again shows it's families. Lower vacancy rate. Gross investment yield is 4.5, but the net investment yield is pretty flat. And you can see that the taxable income is 101,000 from the ATO, or at a family level, 129,000. The multi-flag comes up, multiple incomes going to pay that mortgage, giving a disposable monthly of maybe $8,200, with 30.4% going on typical mortgage, 2,520, and 25.8%, $2,142 going on the typical rent. And looking at the price trends ahead, there is some growth, but not massive growth if I'm anything close to where I think it's going to happen. And the base case, a more significant fall, of course, as well. So it does depend on what happens to interest rates. If interest rates go down, that will, of course, change the story. But I do think that Queensland is starting to see a bit of a shift. Now, let's have a look at the chat. And we've got this one coming up from G2 and Traralogon, I think is how you might pronounce that. I always have a guess at some of those names. So let's put that one in. 3844. This is, of course, in Victoria, in the Latrobe area. 13,000 households, 32% owning outright, 44% are borrowing, 23% are renting. Significant mortgage stress, 88%, 81% in rental stress as well. Overall financial stress, 60%. This is highest of the numbers. 87% of houses, so mostly houses. People ratios, just above 2 there. Some vacancy rates, about 8%. 3.2% gross investment yield, but net investment yield strongly negative, minus 1.6%. So let's be clear, many property investors are losing money on a cash flow perspective. One of the reasons why property investors perhaps are exiting. And that will include land tax and the other bits and pieces, of course, that the government in Melbourne has imposed. Now, if we look at the taxable income, 89,000 compared with 80 for the census, and that gives us a disposable monthly of around $5,700, with 27% going on the mortgage, 1,589, and 23.8%, 1,380 going on the typical rent. And looking at the scenarios, falls. I do not see how property prices can go other than down in this sort of area. Even in the best case scenario, over 3 years, maybe 10%, with 3 or 4% over the next year or so. In the base case, it could fall quite significantly as well. And Cookie Boy has said 6210, which we will look at. Funny that. I think that's one coming later, but I'll do it now. Thanks, Cookie, for the super chat. Mandurah, of course, my favorite postcode. And I do think Mandurah is interesting because prices have risen quite dramatically. In fact, I might look that out shortly because I did some work on Mandurah. But 32,000 households, 31% owning outright, 4% of borrowing, 28% of renting, 34% in mortgage stress, 71% in rental stress. Overall financial stress, 39%. There is still price rise potentially here. Not dramatic, but some. But it's houses, 81%, mostly in this area. People ratio is lower, so that includes some couples and singles, as well as families. Vacancy rate's very high, so that's lost second homes, of course, there. Gross investment yield is 4.1, but the negative investment is, net investment yield is negative, minus 1.1. That's part of the problem. So a lot of people with investment properties in this area are still significantly underwater. And the average taxable, 96,000 from the ATO or 63,000 from the household census. Now, because of a lot of second homes here, that's a little bit misleading possibly, but nevertheless, disposable monthly around 4,200, 47% going on the typical mortgage, just over $2,000, and 35.2% going on the typical rent. And as you see here, there is some upside, but only in the best case scenario. Okay, now let me go back to my other ones because I'm seeing some of the postcodes coming up that are actually already in my list. Let's see whether I can find, just 1 second, let me just reorientate myself, see whether I can find this. I know it's here somewhere. I've got quite a few in the system here, and just a matter of trying to locate them, the right one. No, I'm going to have to cut my losses, I think. Okay. I'm going to look at Hawthorne next. This is one that came in before the show started. And the interesting thing about this one was postcode 5062. So Hawthorne in the Adelaide area. And it's quite interesting looking at what's happened there. So other than May 2019 and May 2023, prices have been rising. And in May 2022, there was a 30% increase, a massive increase. And you can see there that we went from 888,000 back in 2017 to 1.83 million in May 2026, 5062. Now, if we then look at 5062, you can see there that we've got 6,200 households, of which 39% earning outright, 41% are borrowing, and 18% are renting. 40% have mortgage stress, 77% have rental stress, 70% are houses. The people ratio is on the higher side, so some families there. The gross rent investment yield 4.6. The net investment yield is pretty much zero. And looking at the taxable income, 109,000 compared with 114,000 to give a disposal monthly of $7,400. 35% go on the mortgage, $2,600, and 22.8% of 1,694 going on the typical rent. And yeah, there is still, in my scenarios, more upside ahead over the next 2 or 3 years in the best case scenario. But if we get the base or worst case scenarios, there's more likely to be a bit of a fall. Let's move on and look at another one. This is, again, one that came in the requests before the show started. And this is from Vivian. 2258 or Rimba 2258. Now, Rimba's showing these sorts of trends. So other than 2019 and 2023, price rises have been quite strong. Strongest in 2021, 2022. Prices moved up from 656,000 to 1.16 million. And if we look at 2258 in my modeling, you can see, again, it's on the Central Coast, of course, around Wong. I should say it's a low count, so you have to be a little careful here with the statistics because, well, as with all of these things, it's a 0.5% sample, so low counts mean that it's a little less accurate. Nevertheless, we've got 47% borrowing, 32% earning outright, and 20% renting. Mortgage stress at 46%, rental stress at 100%. A lot of people finding it difficult to rent up there at the moment. 80% of houses. People ratios again high, so some families. Vacancy rate was 4.9%. Gross investment yield is 3.4%. Net investment yield is minus 1.5%. And I do see this quite often up in the Central Coast. A lot of investors underwater. Average taxable 90,000 compared with the census 101,000. Multi-flag has come up, so that suggests multiple incomes going on the mortgage. Disposal monthly income around 6,400 on average. 37% going on the mortgage, $2,400, and 30%, 1,993 going on the typical rent. And looking at the scenarios, more falls ahead, I'm afraid, even in the best case scenario. And the base case scenario suggests that we might see more significant falls. So depends, of course, how things trajectorize from where they are at the moment. And just to say to Cookie, have a good sleep. I know you're off now because you got to get back early. So thank you very much, and thanks for all the help you provide to the show. It's just greatly appreciated, Cookie. Thanks. Okay. So what are we doing next? Let's look at another one from my list here. Okay, Max Freedom asks for Piara Waters 6112. So let's put that one in. $6112. $25,000 households with 65% borrowing, so very high new developments, a lot of new land and homeland packages, of course, in the area. Renting at 22% as well. And rental stress at 87%, mortgage stress at 35%, households in financial stress 48%. 90% houses in the area, although they're probably one of those, a lot of close together stuff there. 2.62%, a lot of families. Vacancy rate 6.4%. Gross investment yield is 4.1%. The net investment yield is minus 0.6%. Multi-flag comes out 87,000 from the ATO, 96,000 from the household census, giving a disposal monthly around $6,200 with 34.5% go on the typical mortgage 2160. and 25.5%, 1595 going on the typical rent. And yeah, there's still some potential for further rises in the best case scenario, if not massive. But if things go more pear-shaped, the base and worst case, then we could see some falls ahead. And see what else we've got. Broadbeach 4218. This is in the Mermaid Waters area. And as you say, a lot of building. 15,400 households in the area, 30% owning outright, 33% of borrowing, and 36% of renting. We have 25% in mortgage stress, 80% in rental stress, and 44.8% in financial stress. We have 41% houses, 40% units, so obviously a lot of high-rise in the area as well. People ratio is a lot lower, so a lot of individuals and couples, less families. Vacancy rate's very high, so it could well be some second homes as well as some probably under construction. Gross investment yield is 4.4, net investment yield is 0. Average taxable, 108,000 from the ATO, 91,000 from the census, giving a disposal monthly of around $6,000 with 41.5%, 2470 on the typical mortgage and 37.7%, 2243 on the typical rent. And yep, there's still some upside in the best case scenario, although less so in the base or worst case scenario. Okay, let's see. I have one here. 6152. So this is in the South Perth area, including places like Como and Waterford and Manning. 11,000 households in the postcode. 29.5% owning outright, 30% borrowing, and 35.5% of renting. Mortgage stress at 48%, rental stress at 83%, 6% in financial stress. And that gives us a little bit of a sense of what is going on with regard to houses at 52%, units and other types of property there as well. People ratio is just over 2, some vacancy is at 9.8%, 4.2% gross investment yield, minus 0.6% net investment yield. So another example of underwater from an investment perspective. Average taxable, 114,000 from the ATO and 99,000 from the census. That gives us a disposal monthly around $6,200 with 41.5% on the mortgage, 2600, and 27.8%, 1745 going on the typical rent. And well, I'm struggling to see price growth in this area ahead, but again, it depends on how these interest rates play out. Okay, you've asked for the Mid-North Shore, and that is postcode 2070, my old stamping ground. This is Linfield in Sydney, and here we have 5,400 households. We have 36% owning outright, 37% of borrowing, and 25.3% are renting. We have 36% in mortgage stress, 80% in rental stress, and overall financial stress at 53%. We have 60% houses, more units, and of course more units are being built up and around that area now, thanks to the changed planning regs. We have some vacancies there as well. 3.4% gross investment yield, net investment yield again negative, minus 1.7%. Average taxable, 168,000, 154,000 from the census. That gives us a disposal monthly around $8,400 with 49.6% or $4,200 going on the typical mortgage and 37.1%, 3,140 going on the typical rent. And well, I'm struggling to see price growth in this area over the next little while, even in the best case scenario at the moment. And Snowman asked for 4552. This is Cambroon and areas around there in the Brisbane and Mawson area. And here we have just 3,900 households with 53% earning outright, 31% borrowing and 15% renting. Both mortgage stress and rental stress looks pretty high. I would say that the sample is a bit on the low side, so there's a little bit of flexibility in that number, but nevertheless, it looks pretty high. 92% of houses, vacancy rate's quite high, people ratio is below 2, and the gross investment yield is 4.3%. Net investment yield is positive, just 0.2% positive. So people are making a small return, but not really very much at all. So you are relying on capital growth. Well, according to my modeling, hard to see capital growth even in the best case scenario ahead at the moment. Although that may change, of course, depending on exactly how it all plays out. And did I do Kumara? I'm not sure whether I did. Let's have a look. Okay, I'll just recount this one. 24,700 households, 44% of borrowing, 46% of renting, 28% in mortgage stress, 85% in rental stress, financial stress of 58.5%. And looking at it, houses 79%, so mostly houses in the area. People ratio is quite high, so families. The gross investment yield is 4.4. Net investment yield is minus 0.4%, so another one underwater. Average taxable 79 compared with the census $100,000 in the family level, giving the multi-flag, which means we get a disposable monthly around $6,800 with 34% go on the mortgage, 2340, and 32.5%, 2217 go on typical rent, and small rises ahead possible, although in the base case and worst case, there's a bit of a fall. Okay, let's go back to the ones that we did before the show and have a look at Woodvale. This is from DPM, 6026 Woodvale. And let's look at the price trends information first. So this is over the last decade. And you can see that typical for Western Australia, significant rises. Other than in May 2018, there was a small fall. In 2023, there was a very small rise. And prices have gone from 633,000 back in May 2017 to 1.423 million in 2026. I'm not sure that is that sustainable, but that is what we've got. And if I put 6026 into the model, we can have a look at the data. 6026. Okay. So here we have 8,800 households, 36% earning outright, but 51% of borrowing and 11% of renting. 45% in mortgage stress, not much rental stress going on there at the moment. 87% are houses. And looking at that, the people ratio is quite high. So from families, the vacancy rate's on the lower side. 4.2% is also the gross investment yield. Net investment yield is negative, minus 0.6%. And if we look at the average taxable income, 98,000 versus 111,000 on the census data, multi-flag comes up. Disposable monthly income around $6,200 with 40%, 2,520 go on the typical mortgage, and 35.2%, 2,193 go on the typical rent. Scenarios are, yep, still price growth ahead in the best case scenario, but there'll be a fall in the base or worst case scenarios in this particular postcode. And I will do another one from my series before the show. We're going to look at Balcombe Hills, 2153. Thanks for all you do. I appreciate it. Thank you very much for that comment. Really appreciate it. Look at Balcombe Hills. So the first thing we're going to do is to look at over the last 12 months. Over the last 12 months, interesting that we saw in the July period and October period rises, but since then, and February, March, April, and May, there were falls. And so we've gone from 1.884 to 1.878 million over the year. And we are seeing this trend, seeing this trend of sliding February, March, April, and I'm not surprised that we see it here, and we'll see it, I think, elsewhere as well. And looking at the longer trend, this is the overall story. Excuse me. And you can see here that from May 2017, 1.199 million to 1.878 million now. But as I say, slight correction now over this year. And while we're in, why don't we do another one? But I should, I suppose, just do the 2153 analysis. Do that. All right. 2153, 22,000 households, 30% outright, 48% borrowing, 20% renting, a lot of rental stress, 30% of mortgage stress. 75% of houses in this area. People ratio is high, so again, families. 5.5% the vacancy rate, 3.4% gross investment yield, minus 0.6% net investment yield. And the multi-flag says 109,000 compared with 129,000 for the household. That gives a disposal monthly around $7,600 with 42.6% going on the mortgage and 34.7% going on a typical rent. That's $3,311 for the mortgage and $2,691 a month for the rent. And scenarios are, I think, more falls ahead. So over the next 2 or 3 years, best case scenario, maybe down a few percent, 2 to 3%. But the base case and worst case would suggest a deeper fall. All right, we're going to do another one now from the list, the long list before we started. This is Bundaberg, and in fact, Bundaberg came in from Martin Payne and also Mr. No as well. And interestingly, the commentary there was, it feels buoyant here with so many moving north. However, does the frantic commercial and domestic construction and the influx spell the broader mortgage stress weakness? Well, let's have a look. Let's start with price trends. So let's look at the price trend here. So over the past decade, prices have moved up pretty much religiously, other than in May 2018. So it's gone from $199,000 to $554,000. So yeah, significant rise, but still on an absolute basis, some of the cheaper property that's around. But 4670 is quite an interesting postcode to look at. So let me put that in. Okay. And if I cut back to the slide, this is 4670. Now, I'll make the point, this is a very large area. It includes a lot of communities, 35,000 households in this area, 37% are outright, 33% are borrowing, 29% are renting, and mortgage stress is 25%, rental stress 77%. 83.5% of houses. It's people ratio of above 2, so that would include some families. The vacancy rate's 8.4%. And we had 4.4% gross investment yield and just a small minus 0.2% net investment yield. Taxable income around 80,000 from the ATO and 62,000 from the census, giving a disposable monthly of around $4,000 with 36.5% going on typical mortgage, 1,560, and 33.2 to 1,420 going on typical rent. And I would make the point that, yes, because the disposable monthly is still somewhat lower, that sort of puts a bit of a cap on price growth. There is still some upside momentum, so maybe 2% over the next 3 years on my scenario is best case. But if the base or the worst case comes through, then there would be falls, and quite significant falls potentially at that. Okay, I'm going to do one more from the pre-show request suite. We had a lot of requests, I think more than I actually was able to handle, I think, in 1 or 2 shows. So we'll add them later. But anyway, let's do Kashmir 4500. And let's start by looking at the trends. This is the price trends. And 4500 has shown, again, remarkable resilience other than in May 2023. And we've moved from 621,000 in May 2017 to 1.448 million in May 2026. And if I then look across to the data and put 4500 in, So this is now 17,000 households with 20% owning outright, 50% borrowing. So a lot of new properties, a lot of first-time buyers there, I think, as well. 28% renting, 43% in mortgage stress, 65% in rental stress, 10% stressed investors, 43% financial stress overall. It's mostly houses, 85%. People ratios on the high side, so families. Vacancy rates, 3.7% on the lower side. And 4.1% gross investment yield, but underwater again from a net investment yield perspective, minus 0.6%. And looking at the taxable income, 83,000 compared with 101,000 from the household, giving a multi-flag disposal monthly around $6,700 with 31.8% going on the mortgage, 2,140, and 27.8%, 1,869 going on the typical rent. Scenarios are, more price rises possible in the best case scenario ahead. But if we get a base or a worst case, more likely a fall than a rise. I'm going to do one more here. We had this one come in for Donnybrook, 3064 from Lee, or maybe Lehman. And here we have rises in 2018, 20, 21 and 22, but not so much since then. And in fact, we've got a price of 557 back in May 2017 and a price of 708,000 in May 2026. And in fact, prices are easing back in this area even as we speak. And you can see that over the last 12 months, they were down just a little bit, a couple of percent. So Donnybrook, of course, is one of these high growth corridors, a lot of new properties being built. I keep talking about this as being a significant stressed area. And if we look at 3064, we can see some of that coming through. This includes Craigieburn as well, and Mickleham and Roxburgh Park as well. 35,000 households in the area, 58% in mortgage stress. And you can see there that 65% are borrowing. That's 23,000. That's very, very high because a lot of newly mortgaged people. Rental stress at 71%. Overall financial stress at 57%. Mostly houses, 91% there. People ratios extremely high. So larger families here, 3.19. And the vacancy rate's about 5%. 3.1% gross investment yield. Net investment yield is strongly negative, minus 1.5%. So again, investors losing money on a cash flow basis and losing it because, of course, there's no growth in value at the moment. Average taxable around 73,000. Census said 94,000. The multi-flag comes up, suggesting a disposal monthly around $6,400 with 35.6% going on the typical mortgage, $2,280, and 29.6% at 1,899 going on the typical rent. And scenarios are falls, even in the best case scenario, maybe 3 or 4% over the next 3 years. If you get the base or worst case scenarios, significantly more falls are likely. Okay, I'm just going to check that. Okay, Jason, thank you for the super chat. Can I do Fitzroy? Yes, I can. 3065. Just next door, right? So this is Fitzroy, and thank you very much for your support. It really is appreciated, Jason. This is Fitzroy. So 4,900 households, 18% own outright, 23% are borrowing, but 58% are renting. So a lot of renters. I suspect a lot of students possibly in that area too. A third in mortgage stress, 72% in rental stress, more than 2,000 households there, and financial stress, 56%, so quite high. It's pretty much all units in the area, as you can see there, 59% units. And again, I suspect quite strong population of students. The 18.8% probably represents that in that area at the time. Gross investment yield is 4%. Net investment yield again is negative, minus 1.2%. And on my hypothesis of students, the people ratio is 1.64, so that's on the low side there too. Average taxable, 124,000. Census at 114,000. And that gives a disposal monthly around 8,500 with 35.5% going on the mortgage, $3,000 and 26.4%, 2,247 going on the typical rent. Ahead falls 4% best case over 3 years, 18% base case, and 40% worst case. So there we go. Another one. We think we know it all. 3818. So this is in the Athlone, Ripplebrook, and Rowan area. Again, around Latrobe. 6,900 households in the area. A third owning outright, but 46% are borrowing. Lots of new developments, lots of these, well, frankly, crammed in new low rise, but very significant developments. I think you can see 90% of houses here, so that pretty much confirms it. On 220 squares or something similar, I suspect. 20% are renting. A lot of mortgage stress. Highest mortgage we've seen, 100%. So a lot of people are new borrowers, a lot of first-time buyers, a lot of people struggling. 81% of rental stress. Overall financial stress, 66%. 90% houses. 2.34 is the people ratio. Vacancy rate, 6.9%. Gross investment yield is 3.3. Net investment yield, again, is negative, minus 1.2%. Yes, property investors losing their shirts slowly in this area. 78,000 ATO. 75,000 income from the census, giving a disposal monthly around $5,000, with 39% going on the mortgage, 1979, and 32.4%, 1645, going on the typical rent. And ahead, falls, probably more significant falls, down 11% over 3 years, or 26% base, 46% worst case scenario. And as Jason says, yep, many units, mainly dog boxes being constructed en masse, absolutely right. And it's changing, of course, the character of the area significantly. Part of their zoning and planning, it's a mess. And frankly, a lot of people who would have wanted to live there previously now say, no, I don't want to live there at all. It's not where I want to live anymore. It really is one of those big things where the whole character of the neighborhood has changed. Let's do 2261. That was another one that came in. It's from Jenny. And this is in Bateau Bay, Central Coast, including quite a few different locations in and around there. And 22,800 households, a third owning outright, 39% of borrowing and 29% of renting, 42% in mortgage stress, 89% in rental stress, financial stress at 49%. Households are showing houses 73%, some units and other types of property. And you can see the people ratio there at 2.12%, 13%, probably some second homes and Airbnb in that area. 3.4% gross investment yield, net investment yield minus 1.2%. Average taxable 83,000 compared with 75,000 from the census. Disposal monthly of around $5,000 a month with 47.5%, $2,400 going on the typical mortgage and 38%, 1918 going on the typical rent. And falls, more falls ahead, even in the best case scenario that I can see at the moment. And Snowman asks for 2148. Blacktown, including Kings Park, Prospect, and Arundel Park as well. 23,000 households, 20% own outright, 38% borrowing, a lot of new borrowers there as well, 40% renting, 72% in mortgage stress, 93% in rental stress, 72.6% in financial stress. It's mostly houses, but there are some units that touch property being built there now as well. 71%, it's more than 15,000 households. Vacancy rate 6.5%, gross investment yield 3.5%, net investment yield minus 1.2%. Average taxable 76,000 individuals, 93,000 households. Multi-flag comes up, multiple incomes going on the mortgage, 6,400 typical monthly disposable income, 39.8%, 2,570 going on the typical mortgage, and 30.9%, 1993 going on the typical rent. And I'm afraid I can only see falls ahead, maybe 8% over the next 3 years in the best case scenario, but more significant falls in the other two. Okay, I think I've pretty much. Oh no, one more popped in here. 3797. The shorts awaken. Low count in this postcode, so we need to be careful. As with all of these low count ones, remember it's a 0.5% sample, but nevertheless, we're talking about in the Yarra ranges, Three Bridges, Yarra Junction, Powelltown, etc. And we've got 34% earning outright, 49% borrowing, 16% renting. We've got 85% in mortgage stress. Don't see much in rental stress at the moment, and overall financial stress about 44%. Houses, well, they're mostly houses, 84%. We are seeing some vacancy rates. Maybe it's Airbnb, second homes, don't know. Gross is 3.6% from a yield perspective, but the net investment yield is minus 0.9%. Average taxable, 77,000 compared with 69,000 from the census. And that gives a disposal monthly of just under $5,000 with 46% going on the mortgage, 2156, and 31.9%, 1495 going on the typical rent. And in the best case scenario, well, there's a small potential rise over 3 years, but in the base or worst case scenario, more of a fall. Yeah, it is interesting to see how this is all playing out. Now, why don't I go back to my requests beforehand and just do a couple more there. So we had a request coming in for Parkside from an anonymous 5063. So the first thing I did was to look at the price trends over the past year. It's up and away, other than in May 2023. We went from 874,000 to 1.725 million in 2026. And if we then look at 5063 in our model, $5,500 households, 32% owning outright, 33% borrowing, 34% renting, 25% in mortgage stress, 77% in rental stress, overall financial stress 42%. It's houses, but now other units and other types of property there too, so probably a bit of a change of character possibly over time. And we look at the people ratio 2.1, it's on the lower side, 8.5% vacancy rates, maybe some vacancy properties there at the time that the census was done. 4.5% gross investment yield. Net investment yield is minus 0.5%. Average taxable 109,000 compared with 99,000 from the census. That gives us a disposal monthly around $6,500 with 37.9% going on the typical mortgage, 2494, and 28.8%, 1894 going on the typical rent. And yeah, still price growth possible in the best case scenario, maybe 3 or 4% over the next 3 years. But if the base case or the worst case proves to be more accurate, then potentially a bit of a fall. And Snowman also asks for postcode 7000, which we can do. Centre of Hobart. Okay, 6,500 with 28% earning outright, 28% borrowing, and 42% renting. 34% in mortgage stress, 71% in rental stress, and 46% in financial stress. Some houses, but also some units, types of property in that area. And I know there's more building going on in and around that area too. People ratio on the lower side, so possibly some students and individuals there as well. Vacancy rate was a little on the high side, so again, that confirms that hypothesis, I think. Gross investment yield, positive 5.3%, and net investment yield is positive 0.3%. And looking at the taxable income, 94,000 compared to 96,000, giving a disposal month around $6,800 with 32% on the mortgage, 2222, and 28.9%, 1993 going on the typical rent. And well, according to my modelling, falls ahead maybe 7% over 3 years if things go the way that we think they might. But we'll see. Possibly it will actually be more significantly hit if prices do actually respond to the base or the worst case scenarios. And Joachim asked for 2115, which we can do. We're running close to the deadline here, I think. Okay, this is Ermington in Sydney. And Ermington in Sydney has 4,600 households, 18% owning outright, 37% of borrowing, and 43% of renting, 11% in mortgage stress, 76% in rental stress, and overall financial stress of 48%. It's 6% houses, summer units, types of property there as well. People ratio is a little higher at 2.6%, vacancy rate 6.9%, gross investment yield 3.4%, net investment yield minus 1.2%. Looking at the income, 93,000 from the ATO, but 103,000 from the census data, giving a multi-flag, and of course the settlement income then $6,200 with 49.7% going on the typical mortgage, 3120. I think it's one of the highest we've seen at 49%, and 33.3%, 2093 going on the typical rent. And the scenarios are a bit of a rise possible over the next 3 years in the best case scenario, but the worst or the base case would be a fall. All right. Well, I think we are pretty much close to the end of the show. What I'm going to do is I'm going to do one more from my previous submissions. And this is going to be in from, let's go there, from Charlie, 2820. And 2820, Wellington, is showing that the peak was in 2022 with a significant rise close to 40%, and in 2026 up 20%. And you can see it went from 141,000 to 358,000 in those areas. And if we look at 2820, to give a bit more flavor, this is over in the Dubbo area in the far west. And you can see there that 38% owning outright, 32% of borrowing, 28% of renting, 72% in mortgage stress, and a lot of rental stress there too, 57% in financial stress, mostly houses, 92%. Some vacancies at 14.6%, and the people ratio is a little on the lower side. 2.8% gross investment yield, net investment yield, minus 2.7%. Average taxable 73,000 or 58,000 from the census, giving a disposal monthly around $4,100 with 31% go on the mortgage, 1300, and 27.9%, 1147 go on the typical rent, and ahead price falls more likely than price rises, I think, based on the best case scenario, and the base or the worst case would be more and more significant falls as well. Nev asked for 3358. Yeah, we can just squeeze that one in. Well, I could, except I don't have that one in my postcode. Hang on, 3358. It could be, yeah. Okay, now I can't do that one. The reason I can't do that one is because it's not in the database this month. Now, just to explain, because I do it effectively on a month-to-month basis, and because the sample changes every time, some postcodes with small counts drop out and don't actually appear in the database. And this is an example of one of those. So ask on another occasion, and I'll see whether I can sort it out. But at the moment, it doesn't have sufficient information in my system to be able to actually provide you with a good, robust response. Okay, so I think we are going to leave it at that. I could, of course, go on for a lot longer. I've got lots and lots and lots and lots of more postcodes to look at. What I will do is I will make a separate show. And for those people who put a request in beforehand, I will incorporate that into my Part B show. But I don't think I can do it tonight. Oh, I want to do one more. This one really tickled me. Not least because it's quite fascinating. Byron Bay. Byron Bay was asked for by 1HSV13. Northern Rivers from Berlin, there's a tweet head, escape from Sydney for the wealthy only. Yeah, Byron Bay is an interesting case. So here's the story. And look at the massive spike in 2021 post-COVID. Massive spike. It went from 1.1 million to 2.49 million over that period. But look what happened since then. May 22, 23, 25, small rises and falls. But over the last month, there was a bit of an up, a bit of a down, and it's sliding back down again. So 2.495 in June last year to 2.48, 290 this time, and 2481. Let me put that data in as the model. 2481 Byron Bay, and just cut across to it and just quickly go through it. 5,000 households, 35% hanging outright, 28% borrowing, 35% renting, 73.9% in mortgage stress, 75% in rental stress, overall financial stress, 53%, 68% houses, some units, of course. A lot of vacancies there, 21% Airbnb, second homes, all that sort of thing. People ratio a bit on the lower side as well. 3.1% gross investment yield, but again, negative net investment yield, minus 1%. And as Jason said, spike during COVID. Absolutely it was. Yes, it was. People moved out of Sydney and pretty much everywhere else to get out to escape COVID. And that's why a lot of areas, including Thurrool, where I was at the time, saw massive rises. Average taxable, 101,000, 93,000 from the census, giving a disposal monthly of 6,759. 42% going on the mortgage, 2,860, and 44.4%, 2,990 going on the typical rent. And I'm seeing more falls ahead. A best case scenario, maybe 5% over 3 years is what I'm seeing. And if we get the base or worst case scenarios, then a more significant fall too. And there we go. So I think that's pretty much where we're going to leave it today. So thank you very much for all of your questions, and particularly the postcodes. I hope you found that interesting and useful. I want to make a few closing remarks as we go here. I'm just going through my thousands and thousands of other pieces of analysis I did. I will make another show in the next few days, and I will cover a lot of the other ones. I've got probably 50 or 60, which I'm going to do. But I just want to make the point that where people are at the moment, even Michelle Bullock is saying there is still much more price pressure than there used to be. So a lot of households are under significant pressure. Incomes in real terms are still going backwards. What that means is there's no get out of jail card here. We're not going to see sudden interest rate cuts. Inflation isn't coming back into band until 2028, something like that. Another year or two. That means that it's down to how households can manage their finances. And what I'm finding in my surveys, a lot of households who are under financial pressure, one, don't realize how much pressure they're under because they don't necessarily manage their finances very well. They don't have a cash flow. They don't actually understand where the money's coming in, going out. So my advice always is build a cash flow so that you actually understand where you are. Because the problem is, as I said at the beginning, this is a long, slow burn, and cash flow pressures build and build and build. We are not going to see inflation come down quickly. I do expect to see more government intervention at some levels to try and stop property prices falling too far. But I also do expect inflation to be a problem ahead. I remember the RBA has not been able to keep us within band for months and months and months and months. I think it's going to change. Also means if you do have issues and you need help, it's very important to go to the right areas. And one of the things I always want to do is to highlight the National Debt Helpline, 1-800-007-007. They are, of course, government-backed and supported, and they have debt counsellors there who can help. And I often remind people that you can avoid legal action 74% of the time, according to their statistics. 69% are getting more positive outlook about the future. They can resolve their financial difficulties, 66%. They can improve the mental well-being, 63%, and they can avoid bankruptcy, 53%, and include even improving their physical health at 45%. So this debt pressure is about more than just finances. It's about your financial well-being, mental well-being, and about physical well-being. So it is important to get help if you need it. Also, this tool, which I always recommend, is very relevant. if you need to capture your income and expenditure, the AFCA Statement of Financial Position is actually there and available to download, which allows you to work out your income, expenses, and other assets. That form can then be used if you need to take it to a debt counsellor or indeed talk to your bank about your financial situation. So I recommend that too. And finally, if you are interested in getting information about what we do or would like to support us on Patreon, you can subscribe at various levels. But if you subscribe at the $50 category plus GST a month, you can actually get the data for all 2,000 postcodes in the database. It's updated every month. I'll be sending it out to my Patreon members very shortly. And this gives you all the latest information, all the stuff we've been exploring today at a postcode level, and allows you to make some comparisons between different postcodes and all of those things. The other point I'd make, if you want information about a particular postcode, you can also put a question to me via email in the blog. If you go to the blog, there's a little contact form. If you use the contact form and you can ask me for the one page, I'll send it to you over the next few days. I always get a rush after every show, but you can get the one page summary in the postcode level information if you send me a message on my blog. There we go. I think we are pretty much done. I think, Jason, you've summarized it very well. It's a perfect storm, world of instability. It's going to take a long time to return stability. Years after the stability of the here and now returns, not happening yet. Peace deal, real, you think? Well, interesting question. I'm still skeptical. I think it's likely to wobble. Remember that it's a pre-agreement about discussing an agreement. They got 60 days to do the agreement. But let's hope that they're going to actually be able to open the straits for most, because without it, inflation will rage even more. But I also agree with you. We've had many, many years of bad outcomes because of bad government policy, because of bad lending policy, and a bunch of other things. And unfortunately, this is going to take some time to sort out. But, I'm always optimistic. I always believe in the chance. The future is generally open. And as I sometimes say to people, don't forget that. With everything else that's going on, just remember that the future is still generally open. Obviously, that means that the political decisions we take as individuals is actually quite important, because maybe the people who've been running the shop over the last few years aren't the best people to run the shop. So, just bear that thought in mind. Okay, before I close out, doggies are here. They've been quite good today. We had a little kerfuffle at one stage with the bin collection, but there you go. There's Meteor and Luna just there. And to say that next week we'll be having Leith back on, Leith Van Onselen, and the following week, Tony LeCantro's back for an end of financial year take on the financial markets and everything that's happened. So there you go. Thank you very much indeed for all of your support, all of your questions. I hope you found that interesting. I hope you found it also a little bit revolutionary in terms of understanding the way that things are actually working on the ground, because that's my final takeout point tonight. These averages mask completely. When you look at the detail on the ground, even superficially, it may look similar, but actually, when you look at it, there are quite significant differences. So it is important to go granular and look at that locality information. Thank you very much. Take care. Look forward to the next show. Check out the recorded shows. We do them every day of the week. And of course, every Tuesday at 8 p.m. Sydney, we're on for a live show. Thank you very much for spending time with us. Have a good evening. I look forward to seeing you next time. This is Martin North from Digital Science Analytics, signing off. Take care.